Balance ranges don't last forever, and the one that we're currently stuck in may come to an end as soon as this week. Yes, the strikes in the Middle East will have oil moving, but the reality is equity markets are typically a coin toss up or down in the short term. More importantly, we get labor data this Friday, which should get the conversation going again about Fed cuts versus the continued pause. That's what the market will care more about, in my opinion. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY monthly time frame now that the February bars have officially closed out. What do we see in terms of candle structure and location? In terms of structure, we've got a red body doji here, which just tells us that there's a lack of acceptance on the highs, a lack of acceptance on the lows, and small progress in the downward direction, with the closing print being underneath the opening print. Overall, in terms of location, we've got an equal high and an equal low. The previous month's bar was a green-bodied doji, and we actually closed inside of the previous monthly body. This is a very, very neutral bar-to-bar look here, which, as you could tell if you've been trading the last couple of months, the market's gone absolutely nowhere. So what might we be able to say about this monthly timescale? Let's zoom out here for just a moment and say, okay, what's the overall trend of the higher time frame? Lows, higher lows, higher lows, higher lows in the April tariffs. We've got highs, higher highs, higher highs, and of course we're sitting on the highest high in the trend count. And if you've tuned into the monthly analysis in the past, you know that it's very reasonable that if we were to fall from this monthly balance range, we could easily set a monthly higher low over the previous resistance high from back here. The market's been very structured ever since the sickness low. If you take the pre-sickness high and then the 2022 low, previous resistance turns to new support. The same thing is true here. Previous resistance turns to new support in the April tariff tantrum. If we were going to use previous resistance as newfound support, it's perfect confluence with the monthly 20 SMA as well. That level is loosely around 615. You could even treat it as a zone to about 610. And as we know, that represents about a 10% pullback from the highs here. If we just do something that looks like this, a little measuring stick, there we go. See in this box right there, about 11% pullback from the highs. Markets do that every now and then, and that's well within the bounds of what's quote-unquote normal activity for a trending market. So on the monthly time frame, again, I'm not talking about what happens immediately on Monday. I'm talking about generally on the higher time frame monthly. If we were to make it to here, I'm not really all that concerned about the really high time frame trend. And as you know, again, if you've tuned into the monthly analysis before, we always look at these two examples. If we go back to the dot-com bubble bursting, we create a monthly double top. Here's the neckline over here. The monthly yields a lower high underneath the monthly 20 SMA. We get a lower low. Painful washout 1, painful washout number 2, right? Go take a look at the Great Financial Crisis, 2008. Here's your monthly double top. Here's your lower high underneath the monthly 20 SMA. Here's your lower low underneath the neckline of the double top. There's the really big painful washout, right? You could even take a look at 2022. If you jump over here, here's a high, here's a lower high. You technically made a lower high underneath the monthly 20. You were already in a monthly lower low figuration here. We don't really have that as of right now. The last thing and therefore what's the takeaway, right? I wouldn't predict that, oh my God, the market's going to crash and burn and go to zero. I mean, a 10% correction is absolutely bearish intraday, intra-week. To get here, it would be kind of nasty, but it's not a big major market crash. The monthly trend will remain in the upward direction, right? That's the main point. The last thing I want to talk about here on the monthly time frame is just simply, yes, the war between Russia and Ukraine maybe played a role in a little bit of the topping action that happened here before 2022, but I would really encourage us to focus on Fed policy. What was going on right into 2022. The Fed had just started the most aggressive rate hiking cycle in the last, 50 years, give or take? So I don't think that you can compare apples to apples here. This is like apples to oranges. We're currently dealing with a Fed that is, more realistically likely thinking about Fed cuts at some point, not jacking rates back up to 5%. So I don't think, again, just using the excuse of, okay, here we go with a war in the Middle East, the market's going to crash just like it did over here with the Russia-Ukraine situation. Two totally different situations. And again, it's the Fed policy that is the big differentiator. I will just take the moment here to bring out the Fibonacci's from the low of 22 up to this high. All I'm sort of trying to indicate is that the Fib 38.2 is underneath this pullback here, and it's actually aligned beautifully. If we take the Fib from here to here, the 38.2 is the monthly 20 SMA, and it is the prior high set here at roughly 615, 610. So if the monthly chart pulls back into that higher low thesis we just talked about, it makes decent sense out of a Fibonacci retracement perspective that we're not doing anything quote unquote wrong for the higher time frame trend. And we've talked a lot about pullback just because that's kind of what the spirit of this sideways consolidation has been. Recently, we've seen that supporting evidence has deteriorated over the last couple of months. But if the market breaks out, I mean, there's nothing saying that we can't just continue in the upward direction, getting some sort of like bull flag consolidation break here for some sort of move higher. And remember, in the past, we've talked about 730 roughly as the measured move target. Before we drop it on down, actually, you know what? Let's do it now. Let's go to the weekly chart. And let's take a look at our expected moves, and then we'll talk about candle structure and such. But I do just want to show you the measured move, or expected move rather, for the month of March based on options pricing, 717.74 on the top side and 654.24 on the bottom side. We really did not even test anywhere close to the upper 50% of, let's draw a straight edge there. The upper 50% of the February range. I mean, we wicked into it a couple of times here, but a majority of the time was spent underneath the 50% of the expected move. So it'll be interesting to see where we develop into the month of March, ultimately is what I'm getting at. If we were to extend down towards this 654, notice that that does technically align with these prior lows over here, which is a great segue into our trend conversation. So let's go back to the clean drawing set and let's just take a look at candle structure and location. In terms of structure, just like the monthly, we've got ourselves a red doji bar here, which is very indecisive. I mean, it doesn't take a rocket scientist. And if you've been trading actively for the last couple of weeks, you know this range has been continuing to do exactly that, just range. So not much to say structure, location. It's about as neutral as it gets, right? We are kind of riding the weekly 20 SMA. We started to break that a little while back. Notice in these lower wicks, we were breaking and piercing that 20 SMA. We did the same thing this week, but we did close more meaningfully away from it. I would just say that, of course, this threat is the sort of unlock, if you will, to a weekly trend reversal, which would bring you into these equal lows down here, which is the lower bound of the March expected move we were just looking at, roughly 653, 654, and that is a breakdown underneath the range low, 676, 675, right around in this zone right there. So that would be 676/75. Okay, so if that is taken, I'm trying to illustrate that the weekly trend will flip to down, right? You will have highs, you will have, over here you had lows. We're building out. This is certainly an attempt at higher lows. If you fail that into a lower low, the weekly trend flips to down. And why am I starting to make this point? Because for the monthly chart to actually set a higher low firmly, the weekly trend actually needs to flip to down. So if you're sort of looking for that higher time frame, quote unquote, reset to the market, you actually need, you can always just correct sideways through time. That is a viable option for markets. But if you're looking for a price correction, the weekly trend needs to flip. You need to get price acceptance underneath these lows if you're going to get that monthly pullback. And so far, there's just no indication of it. So instead of just continuing to talk about how sideways this market is, we'll throw in a couple of measuring tools and then we'll move on down to the daily. We're still consolidating over the fib 38.2. That's technically slightly more bullish, as is the hold over the weekly 20 SMA. If we bring out the anchored VWAP set here, you can see we really aren't doing much in the way of damage to the anchored VWAP set. We dipped a toe into it again this week, but we've closed above. This anchored VWAP is the only one that remains a little bit of a headache for this market on the top side. And then, of course, the high volume node is just going to look really, really protruded here at these highs now that we've ultimately done what we've done here. I mean, just look at it, right? You've got to break away from this range if we're going to do something more important, and we just aren't really doing that as of right now. Let's take this thing down to a daily time scale where we can hopefully get a little bit more nuanced. We'll see. Again, it's like if you've been trading the market, what have we been saying in the pre-market streams? It's MF, right? Not MF doom, but maximum flexibility is absolutely required out of this market. So expected move for this upcoming week is here in the gray shaded area. If you're not familiar with this sort of study, check out the video tutorial in the top right hand corner. 699.97 is the upper bound, and technically speaking, that's a brand new all-time high. It's certainly a higher high over the highs of last week. That does strike me as being slightly more bullish than bearish, believe it or not. But unfortunately, we could say the same thing about the downside. We have 672.01 as the lower bound of the expected move, a lower low from last week's low, and a lower low from the balance range here. So this is why I said in the intro, it seems like this week, be it up or down, the market may be able to break the balance range, especially add in the catalysts of, yes, volatility on the Middle East tensions, but more importantly, the labor data that we're getting this week. I think we could get it. I think we could finally break from balance. So we shall ultimately see. In terms of the major levels, nothing has really changed here. So let's keep it simple on the daily timescale. You could see the set of highs, 697.85. If we Brigade bolt up and out of that, great, bullish, no reason to argue. If it's a look above and fail and you come back down into range like this, target the mean reversion. I would say on the top side, my first place to look would be here at 689.75. If the market breaks down, right, you need to see the Brigade bolt underneath the zone here. I would primarily say between 670, 650, and 675. Once that happens, you could start to target some of these downside levels. If we go look below and fail, something that looks like this, mean reversion is first here to these really well-defined lows at 680.25, and then I would look for this midpoint of the range there, which we've talked about quite a bit in the past at 686. Those are the mean reversion plays. Maximum flexibility is really the name of the game. If you've taken an approach where you're like, okay, this is it, the market's got to go, it's going to go higher, it's just got to break the new all-time highs. If that was you on Wednesday, right, then you sort of just got a nice smack in the face on Thursday, Friday, and unless you actually get the break over the range high or underneath the range low, it doesn't make sense to have a directional bias here. And I know that is not the stance that people come to the video for. I know, I see it in the comment section. Oh, this guy always says the market can go up, down, sideways, whatever. Like, okay, if you're Mr. Bull in here and you just got a nice pie to the face on Thursday, then, I mean, what do you want me to say, right? That's exactly what the market's been doing. So just understand the context that you're trading in. Once again, it's like a day up, a day down. Oh my God, we're going to break the bottom of these lows. And then a day up hard, a day right back in, failing the moving averages, a little bit of a reprieve on Friday, like very choppy situation. So please, if you're having a hard time in the market, just take a step back from the desk and say like, okay, are we actually moving anywhere outside of the balance range? And if we're not, that maximum flexibility needs to continue to be at the forefront of your brain. I think we can get close to some sort of break or a break this week based on what we've talked about so far and what we'll continue to talk about. But until it actually happens, don't jump the gun, right? Do not jump the gun. The last thing I'll say here on the SPY daily before dropping it down to the hourly is that the range is starting to compress a little bit, which is interesting because back here we certainly had a megaphone pattern, right? Something that looked more like that. So you draw on the completed pattern and suddenly does this start looking more like a diamond top? Perhaps. Would I front run this on just a break of the trend line? No, absolutely not. I need to see, like, you can't trust this market further than you could throw it. I need to see 675, 674, 676. This zone in here needs to break if we're actively going to seek continuation in the downward direction, right? I will say, if we are coming into the lows after highs, slightly lower highs, meaningful lower high, if we do this and then we're down here, right, I of course will maintain the maximum flexibility stance, but I would generally think that the odds are increased coming in after multiple lower highs for some kind of range break. Again, I'm not front running the idea, but I would just be very open-minded to it, right? Very open-minded to the actual break of the low rather than a quick snapback and okay, here we are right back in the midpoint, right? So that's my 2 cents on the daily. I hope you are trading well, or at least, being very reserved in your trade size, trade frequency as the market continues to just balance like this. On the hourly chart, what can we say? All we can really illustrate is the sustained failure of both sides of the trade, right? If you're early in the week on Monday, Tuesday, you see this rally here, you want a lower high to rotate back to the bottom if the bears are going to keep control. Okay, that doesn't happen via the gap up on the Wednesday session. So, okay, maybe the bulls have the gift currently. Capital T, capital G, trademark, registered, copyright, and the whole 9 yards, right? You guys know this by now. So the bulls have the gift on the Wednesday gap and go. All right, here comes NVIDIA earnings. What do you want to see? I mean, picture perfect situation is here, 689.75 holds. Not so picture perfect, but still okay, is that the moving average cluster holds after a gap fill reversal, because keep in mind, that was an unfilled gap, right? Then you get Brigade bolt back here and you're higher. Well, did that happen on Thursday or did that happen on Friday? Survey says absolutely not. So just when you think the buyers have the gift, the sellers say no thank you. And just when the sellers have a gap down and let's target the bottom end of the range, nope, rally back into mean reversion. So once again, if you're taking a directional stance on this market for anything longer than, 5, 10, 15, 20 minutes, 30 minutes intraday, good luck, right? That's just not the tone of the market currently, and avoiding getting chopped up in the box is probably your best bet. And again, just cycle that out one more time. This is also the box. Let's come in here with a Fibonacci just to sort of gauge, like, where are we relative to, let's take a couple. Let's come from here to the low. We are currently in no man's land, right? The 50% mark. If you're a stronger bull, you want price acceptance out here for 100% retracement. If you're a stronger bear, why aren't we here testing the bottom end of the range? So pretty neutral, right? Let's come in from the low of last week's range to the top of last week's range. We closed literally in the midpoint. If you're a stronger bull, you wanted to see it up here on the pullback, no dice. If you're a stronger bear, you wanted to see it lower on Friday, no dice, right back to the midpoint. I wish I had something stronger to tell you. And once again, like, what separates the traders who will make it through to trade successfully on the break of this balance is the people who keep their money and their accounts intact when we're just going sideways and doing nothing. So again, like, that overly biased stance, the market must go up, I must trade longs, I must trade shorts, I must do that. You don't have to do anything here as a retail trader, which is one of your advantages, which I think is not frequently discussed, right? At an actual fund, at a firm, it's like, okay, why are you not producing, right? Come on, you got to be making trades. You got to be doing something for us. Otherwise, you're just, So anyway, rant over. Anchored VWAPs intraday. We're in the middle of the cluster. What do you want me to say other than what I've already said so far? Let's drop it on over to the market internals. What do we have? If you're not familiar with the market internals, check out the video tutorial in the top right-hand corner. Mild volume inflows on Thursday, even as the market's coming down, is the only nuance that I would sort of pull out of this as a thread. I don't think it's enough to make me feel any particular way about, okay, we should be all bulled up because we had inflows on a down day. Kind of know that NVIDIA brought the market lower there. The RSP equal weight looks great, so I won't, keep you waiting for that. I will just bring it up as it's relevant here, RSP. Take a look at this thing, just kind of knocking on the door for a Brigade bolt over 205 in the blue sky territories. I think that would honestly be the takeaway from the day on Thursday, which is just that the heavyweight Mag 7 stuff clearly dragged the weighted index lower. In terms of Friday, as we just kind of went sideways and balanced, there's a small grind in the upward direction. The cumulative build was bearish here, incredibly flat on the index score, small red on the advanced decliner. Volume flows were slightly out of the market. There's just not a lot to hang your hat on here, and I think trying to get overly nuanced in the balance range, it'll lead you to trying to be more bearish or more bullish when in reality, zoom out, take the 90,000 foot view, there's not much to really say or do about that as of right now. I just realized that I didn't sign into Market Profile in the background, so we'll skip Market Profile for now. Maybe I'll throw up a screenshot of it right now in post, and I'll maybe make some text annotations, but let's move on over into our QQQ cash ETF. Let's see what's going on over here. With the monthly time scale, we'll keep this thing moving from a top-down perspective. This is the spiders. Let's go Qs. And let's go clean drawing set. There we go. That's fine. All right. Let's go with the monthly 20 SMA just so we can kind of see where that reference point is. This is great. Awesome. Okay. A little bit more of a body to the doji here. You've got a solid-ish red-bodied bar, still upper wick, still lower wick. The candle close, of course, being underneath the opening print. Sellers made slight progress in the downward direction. Lower high and lower low, a little bit more notable, less balanced than the S&P, at least on a bar-to-bar count. But generally speaking, this market here is still balanced over the last, 5 months, really not doing much in the way of movement directionally. Same concepts as the spiders. If you were to pull back, monthly 20 SMA is the figure here, about 540 and the previous resistance high. Same concepts of previous structure, previous resistance acting as new support. We would look for the same thing here if the market were to pull back. And that would be a great spot for the mole thesis. The monthly higher low mole is what we're looking for at 540 if the Qs pull back a little bit more aggressively here. And we can even take out the measuring stick and just reinforce from the highs down to that area in here. That would represent about a 15% pullback. That's fine. That's still within that striking distance of the average, so to speak, of a pullback in the NASDAQ, which is more volatile than the S&P, right? Notably so. Let's bring out the Fibonacci's and come in from the April lows primarily up to the highs. Just pointing out the Fib 38.2 is a smack on the money there, right at that 545, 540-ish zone as previous resistance. So all set on the monthly, not much to really glean. If this is going to be a bull flag in the upward direction, you could start to come in like this and say, all right, where does that bring you as a breakout? 817. Do I really think the market's going here in short order? I don't think so. Not this month. I wouldn't think so. Let's maybe leave that one on the back burner. If we were to take out the highs, then yes, I would be bullish, and that would, of course, be a reasonable reference in the upward direction, but let's go one step at a time. So speaking of one step at a time, let's go down to the weekly, and let's see what we could see over here. A little bit more bearish than the S&P 500, so not in terms of the bar. The bar is, you've got just, again, a doji here. This one actually has a small green body to it. But look at the location of it. Underneath the weekly 20 SMA, you already have a lower high potentially brewing. This, of course, is already a lower low. So you are actually in a weekly downtrend here on the NASDAQ. The next thing to really just watch for is, do we wash it out underneath this low, which, of course, brings you back into starting to think about the monthly higher low pullback. I would say weekly 50 SMA could be the first reference, and then really looking for that downside action into 540 that we were just discussing. Of course, this would just be a nice range rotation as well, right? We're typically looking for range doubles whenever we break a balance. So there you go, smack on the money at 540. Let's bring out the Fibonacci's. And again, I'll try not to be overly redundant here, but kind of in the middle of no man's land. If you're more bullish, you should be over the 61.8. That, invert it, and it would be the 38.2 on the top side, just like we did in the S&P. We could come in here with the Qs, anchored VWAP. You can see you're inside of the stack. See how we're underneath, what is that, 4 or 5 of them as of right now versus the S&P 500, which was only underneath one of them. Let's break out the high volume nodes and see where we're at relative to that on the NASDAQ side. So this is the highest volume node there. We're above that. If we fail it, that's where I think the door is wide open. And just look at the structure. I mean, it makes good sense that you could rotate through this sort of low volume valley into the next major shelf, which just naturally aligns with price structure. It makes decent sense, right? Let's take this down to the daily chart. Let's get a little bit more granular on the NASDAQ. We could see the balance range. I would say that this is more bearish. Right? I was willing to change my tone on Wednesday, and you may have caught that in the midweek video there, but the Thursday washout completely gets me back on the other side. And that's where, once again, this maximum flexibility really comes into view here. If you're not willing to just quickly flip from, okay, this is a little bit more bullish to, okay, this is a little bit more bearish, or okay, this is a bullish thing that failed, right? If you hang on to like, oh no, this break, it must be bullish and the market has to go higher. And oh my God, this is just a pullback. It's going to do this. That approach will get you hurt big time in this market. Not being, having the flexibility to objectively look and say, okay, we backed off hard from the 50, lost the 20 all in one day. Then Friday is just spending consolidation back in this balance range here. So this is an unsuccessful breakout, right? This is unsuccessful follow through from literally the follow through day of what we had from Friday of last week, or not last week, but the week prior, right? So all things considered, we're right back to the starting point. And ultimately it's highs, lower highs, equal highs. So maybe this just turns into a new balance range where you could say lows equal lows. Maybe you have a higher low here, TBD. But where does that really leave us? Like, okay, generally we're removed and in a weekly downtrend. Sure, the daily might be balanced down here, but you're underneath the moving average stack. You're back here. You have a failed breakout. Like in this consolidation, I don't know how I could see it as anything other than slightly more bearish for the market. If we could improve and show that buyers are stepping up over 613 with acceptance, I'd be willing to change my tone. But until that actually happens, survey says no, right? Let's take this thing down to the hourly chart. And let's just continue here. And like another thing to just be cognizant of is like the market will break at some point. And if you just like lose focus and you just say, throw your hands up in the air and like, oh, this market sucks. And like when it starts moving, I'll come back to it. Like you got to kind of stay on top of the ball here and figure out, okay, if this level breaks, where are we going next? Because that may happen in a 15-minute period intraday if the market really gets hot and heavy. Or if the market rips to the upside and we reclaim the 50 and we're here, it's like, okay, you should probably still know that this is your target, right? And you need to know that the 613 reclaim is what you're looking for. And you need to know on the hourly chart that if you get here, that might be slightly more neutral just because you're outside of this little balance over 609. So in terms of the hourly trend, lows, potential higher lows, highs, higher highs. Is this an hourly uptrend? I would say starting to look like it. I would say it's in the midst of reversing on this kind of thing in the downward direction where this suddenly turns into a lower high. So once again, 609 is kind of that key level. If you're balanced in here, I would take a very open-minded approach, probably slightly more bearish than bullish. Oh, look at that. Background from Zoom. Thanks, Zoom. I could have swore I canceled that. I guess not. Anyhow, this here gets me back on the bull side, right? And this really, or I should say, what should I say? This is like neutral to bullish, because the hourly trend is up. This is more bullish over 613. If this does this and then stuffs here, game on for the bears. Rotate to the bottom end of the range. So maximum flexibility is still the name of the game. I won't be overly prescriptive with the pathing. Those are a couple of ideas that I would look for. But again, just like maximum flexibility is the name of the game. Not the answer many people want to hear, but that is the reality of the market we're in. 38.2 is here from this high of the breakdown. If we were to consolidate under 609, I think just naturally aligning with what we just said, that's a little bit more bearish, and your trigger is probably under 605.25. That makes decent sense to me. Let's drop in the intraday anchored VWAPs. There you go. We're inside the cluster. You learn something when you clear the stack up here. You learn something when you get below the stack down here. Makes decent sense. Let's grab a look at the NASDAQ internals. There we go. As you can see here, we have volume outflows on Friday, a little bit more bearish than the S&P. In trend lower zone on the advanced decline line, and a cumulative build that wasn't actually, yeah, it was. Okay, there we go. There's the number right here. 6,700 in the downward direction, 6,000 plus or minus is the influential read. And okay, there you go. At the exchange level, a little bit more bearish on that Friday session as we got what looked like just naturally intraday, a bit more consolidation. So I would take the same approach that we just described in the S&P. Don't let the internals overly sway your opinion because we are ultimately just in a balance range. If you want to say there's a tiny sliver of an edge to the bears, fine. Not a problem. All right, let's hit the IWM, Russell 2000. Let's go up to that monthly time frame. Let's see what we could see over here. And let's fix the charts as we should. There we go. Appreciate it as always. Thanks for bearing with me. And let's go out here to the clean drawing set. I just realized that I didn't show you the QQQ expected moves on the higher time frame. I apologize. Let's go to the weekly chart. There you go. 572.26 bottom side and 642.32 on the top side. QQQ. There it is. All right, that is your monthly expected move for March. Let's go to the IWM. Let's go over to the clean drawing set first, and then I'll make mental note to show you the expected moves there. Balanced, back-to-back dojis, upper wicks, lower wicks, small bodies, consolidation here. This looks more like a bull flag in the short term to me than anything else. We know that small caps would be a beneficiary to rates being lowered by the Fed. The 10-year interest rate is already precipitously falling off of a cliff, trying to tell us a little bit of something about the future prospects of inflation or maybe the labor market. But for now, we are still above what I would consider the key inflection point, this breakout from back here on the IWM. So no real problems. This is a weekly chart. I just realized. Let's go to the monthly. If you take a look at the monthly bar, a little all over the place on the IWM. Sorry to the IWM fans out there. But inside inverted hammer, pull back here, fine. That's that same inflection point we were just looking at anyways on the weekly. There we go. Monthly trend is up, so this higher low is what we're looking at, right? Something right around in here, around that 240, 270s. As long as we're above that, trend remains up, no problemo. We could even hit this with a Fibonacci coming from here up to here. That would be well above the Fib 38.2, no problems. Let's go on down to that weekly chart now. Let's take a closer look, and there it is. So if you were to break this, right, some kind of pullback towards this, no problem. Right? You fall into the weekly downtrend, you ultimately offer a monthly higher low, you're here, and then you're looking for a move back in the upward direction. Let's go ahead and take a look at, let's go in here with the anchored VWAPs on the weekly, sort of in the top cluster, if you will, well above the below stack down here, no problem with that. And let's hit this with the weekly volume profile, zooming out. As we know, this is literally all-time highs, so not much to really glean. That is the high volume point right there. We closed right on it. The more time we spend above bullish, the more time we spend below, not necessarily bearish, but increasing odds of a potential pullback towards this area, as mentioned, around 245 roughly. Let's take this down to a daily chart, back to the IWM, and see what we can glean. If you want the expected move, it's this box right here. The cyan crayon up at the top side is kind of hidden in there. That would be around 269.30s, give or take. Then on the bottom side, we have 253.57. If we are going to see a rotation, you need to see this. If we are going to see a rotation to the downside, you need to see this. So keep it simple. No need to overcomplicate this. Even the Russell, which was trending very cleanly back here, is not immune from the balance range. Keep it simple. 265, 258. Those are the two figures. You're either up and out, or look above and fail is fine, or you're down and out, or your look below and fail is fine as well. That is it. I would say primarily I would be interested in a more strong headwind, a stronger bearish argument to the S&P. If not just the NASDAQ remain in the daily downtrend, but also the IWM drops the 50 and starts to look like this. If that's the case, then yeah, absolutely, that's going to be a more problematic look for the S&P 500. I do like that on Friday we have a hammer candle off the 50. Give a little bit of credit to the buyers on that one, but nonetheless, just in the midpoint of the range still. You could argue for range compression, and this is that same weekly bull flag that we were just talking about. There it is. Some kind of move out of this could maybe start to align with a trend line break as well. I'm not a fan of diagonals, much prefer the horizontals, so 265, not going to change my mind from that one. Let's take a look at the hourly chart. Anything to really glean here? Probably the same narrative as the S&P, where in this section of price action here, you're holding up over the 20. Why is it that on Friday the buyers can't sustain that? Well, probably because the PPI inflation read comes in red hot and is not enticing at all from an inflation perspective. So that's small caps in a nutshell. I wouldn't overcomplicate it. The range is well defined. If you're in the upper 50% here, great, that's slightly more bullish. If you're in the lower 50%, slightly more bearish. This and this, I know I sound like a broken record, so let's just keep moving here. Here, I'll just do it to be congruent. Why not? Intraday anchored VWAPs, where are they? Not the futures VWAPs. Give me intraday anchored VWAPs. We're underneath them. They're in the midpoint of the range. Slightly more bearish consolidation below. I think that checks out. If you really want to slap a fib on it, fine. Come from the low up to the high, and we are in no man's land here. All right, all good. Let's take a look at the rusty side of the market internals and see what they tell us. Not much other than balance. Look at this, back and forth through the zero mark. You could see small here, but lower here. I mean, just not a lot to glean, right? So let's save ourselves the time this weekend, and let's just jump back from here into our sector watch and see what we've got in terms of S&P sectors. So keep in the back of your brain that as the sectors are rotating, this is what the broad market's doing. Ready? So who was leading, who was losing, and where was the weight for the sectors? Well, XLU utilities, which are a lightweight and defensive sector, lead the pack this week, up 2.71%, followed by staples, which is lightweight and defensive as well. So that already is not really a warm and fuzzy feeling about, okay, let's rock and roll, blue sky territories. IGV had a decent rebound week. Those are the top three. At the bottom end of the barrel, we have semiconductors. That's heavyweight, and that is risk on. So what do we want? I'll just use an R for risk on. Mag 7, I know these aren't necessarily the 11 sectors, but as playing a key role for the watch, right? So heavyweight, risk on. XLF, heavyweight, risk on. XLK, heavyweight, risk on. All of these things are red last week, right? As the market continues to grind around inside this balance range. NVIDIA reports stellar earnings, some of the best earnings we've ever seen. Incredible margins. Can you imagine 75% margins on $66 billion of revenue? Unbelievable, right? And yet, what does NVIDIA do? NVIDIA is lower to end the week. SMH is lower to end the week. Failed breakout. Look above and fail. So again, it's like, I don't want to say the writing's on the wall without actually seeing the breakdown here first and becoming overly bearish, but it sort of seems, as a weight of the evidence approach, that the bears do have the edge. Utilities breaking out to new record highs. Yeah, it's green for the S&P, but it's defensive in terms of the rotation. Let's take a look at XLP. Same thing. Bull flag up here at the highs. Looks ripe for a new all-time high earlier this week, and that is D for defensive in terms of its rotation. Let's look at software. It had an okay week bouncing off these lows. You're underneath the daily 20 SMA. What I do like is that it's starting to support this. See this previous shelf? I talked about this. You go back, watch the video. Excess low, higher low back in range. Let's see if we can become more constructive. IGV is going to be a top watch for me this week. It's primarily going to revolve around Microsoft, in my opinion. Palantir will also play a key role there. So constructive first steps, but I would say you're dancing right on the edge. 79.65 key level IGV. XLV. This is a defensive sector. People are not going to, waver on healthcare just because, oh my goodness, we're, headed towards a recession. Look at this. I mean, breaking out of a weekly cup and handle. We've been talking about this pattern for quite some time now. Biotechs look pretty good. Drug manufacturers, Johnson & Johnson, new highs into the end of last week. You're starting to break the cup and handle. XLV, let's get on the horse. Let's see what we get. It's still defensive technically for the broad market, right? So that would be bearish for the S&P 500, even though it's higher. If we look at the XLB, this is... it's the lightest weight sector in the market, so yeah, it looks great for a potential bull flag breakout. It's not going to drag the S&P higher. Let's go XLE. What's going on with energy? Energy is a little inflationary. I would imagine this goes a little bit bananas over the weekend with the Iran strikes, right? So please keep a close eye on CL over the weekend. If you're a oil futures trader, then you probably have to be Johnny on the spot here and understand everything. I'm not going to pretend to be a geopolitical oil expert. I'm not going to tell you that this Strait of Hormuz closing is going to mean crude is going to be at $70. I don't know. I would imagine that there's volatility in crude, and that's kind of the extent of where I'll leave that. But energy overall, it's a lightweight sector for the broad market. It's not really going to drag us to a new high. And obviously, it hasn't dragged us to a new high. If anything, this is just preventing the S&P from breaking down more aggressively, right? That's been the story of the market. XLC, I've got to give this thing some flowers. This is a heavier weight risk-on style sector, and take a look. I mean, we could look no further than Netflix finally clearing up a little bit of their deal, but inverted head and shoulders. Is it time to rock and roll? Are we going back out to new highs? That certainly would alleviate some of the downward pressure on the S&P 500, but honestly, what does that sort of mean? If you're alleviating the downward pressure and you're trying to rotate to the top of the balance range, then we probably don't have a directional market, and you probably fade the top of the balance, right? So XLC looks great. It's one of the only heavier weight risk-on sectors that looked good, and it's primarily due to that Friday session there. Let's take a look at real estate. Real estate looks like it's ready for a bull flag break up and over 44, even if it pulls back to 42.70. Higher low here, it is a lightweight sector. XLI Industrials, 8%. We'll give this thing a little bit more credit in terms of its weighting. 8-ish% of the S&P looks good in a bull flag. John Deere, Caterpillar, Cummins, all those names possibly out and up over this 178.30. We'll see if it can pull the market higher. If all of the risk off stuff continues to move higher and this risk on stuff can at least go sideways, maybe we have a move to the top of the range in the S&P and then we fade the high. Let's go on over to the XLY. Still looks horrible. Right, no real definitive trend, spaghetti on the moving averages. Holding the 200, we'll give some credit there, but really rough looking chart. I mean, could you try to say that it's forming a bottom in here? Maybe. I would need to see at least this, if not this. Show me some kind of higher high up and out over that after this little rounded low. Maybe, but for now, this is just bearish consolidation in my view. Let's go on over to the SMH, where it certainly is worth spending a little bit of time on this look above and fail. So breaking out ahead of NVIDIA earnings only to fail back below, And then not only is there a lack of retest underneath 418.40, but immediately we just start rejecting the daily 20 on the breakdown. So to me, this is bearish. Even if you rally, I would expect a retest lower high 418.40, and then this opens the door into the 50. That will put downward pressure on the S&P 500 undoubtedly, and really the NASDAQ as well, right? Clearly much heavier weight and influence over the NASDAQ, but nonetheless, that's your key low. If you're underneath 401.50, goodbye, right? Goodbye. Very cautious in here, underneath 418.40. Look above and fail, technically speaking, should target the bottom end of the range. In this case, maybe we're already there, hypothetically, but I would think lower to here, really, at that 389.40. So that's SMH Mag 7. We tried to give it like 1 day's worth of credit on that Wednesday session back over the neckline here after holding the 200. Nope, highs, lower highs, lower highs, rejecting the daily 20. And, you could see on Friday just even worse. Consolidation under the 200. You've got this big gap to close underneath you over here. It looks bearish. It looks heavy. I don't really see a way forward for the broad market in terms of substantial upside breaking through the top end of the balance range until this bottoms in a more meaningful way. And currently, this is not a look for it on Friday. Let's go on over to the financials. More concerns about AI taking over some of the wealth management, tax planning, and just general financial sector jobs. So more pressure after the 3-day rally back to the top side, just right back to the lows. This is what we were talking about on the Wednesday video. This lower high seemed ripe, and that's kind of exactly what we got. Under the 20, under the 200, I don't think you're out of the woods here in financials. I mean, look at a Goldman Sachs, for example. This one just comes to mind because it was probably the most brutal. But look at this on the Friday session, just straight down here. You could say that there's other things, catch my drift, going on in the headlines about Goldman Sachs, but nonetheless, the chart is not really in a constructive form at all. Let's finish it up with the XLK, the heaviest weight risk on sector that there is, the technology sector. Does it look any different than the Q's NASDAQ? Absolutely not. Weak here on the lows. That looks like a flush point. Daily 200 SMA test. You're in a downtrend. Highs, lower highs, lower highs. The weight of the evidence, which is the whole point of the back half of this show, the weight of the evidence looking through these sectors screams defensive posture, risk off, right? So we'll say off, because O can also stand for on. Defensive, risk off, and downtrends look like they may continue based on breaks of some of these lows into key reference points to the downside. Also think about that XLY 50 SMA that exists underneath us, even like the Mag 7 rejecting the neckline again, right? Let's jump into the ratio charts. The only thing that's going to be a bright spot over here is, of course, that XLC. There it is. Already did a little bit of my homework. So yeah, it looks good there, but this does not look good. This does not look good. This does not look good over here. This is saying defensive. This is saying defensive. Even healthcare is saying defensive over here. Industrials look okay. Energy, lightweight, not really caring about that. Same thing over here. And we don't even include materials just because it's so lightweight. Let's jump into the B set or AB set here. And if you're not familiar with ratios, check out the video tutorial top right-hand corner. That'll get you covered over there. XLK, SHY, like not good new lows, double topping, if you will, over here. I would say that this might remain a little bit more neutral. This doesn't look good. This doesn't look good. You see what I'm saying? Like the weight of the evidence approach is not aligned with, oh my God, let's rock and roll to new all-time highs. If you look at the GC ratio, lows there, that's bearish. This TLT ratio, bearish over here. Bitcoin tried to make a stand at the bottom end of the range. Let's actually just open this up on a daily chart real quick. It's trying to make a stand at the bottom end of the range over the weekend here. We came into it pretty aggressive on that Friday session. So we'll see if we can hold over that 60. It's in spot prices, it's 65.1, give or take. And primarily, if you're trying to follow along the Bitcoin narrative, you just want to stay over that hammer high from the look below and fail. Right, look below and fail, needs a higher low, and then through the top end of the range is more bullish. That is what we've got on that one. Let's go from the B set over to the dollar and rates. What do we have going on over here? Rates breaking down, I would say, should likely pull the dollar slightly lower. I would think we have lower odds of breaking through this 97.97 zone with rates doing this. And I continue to think of this as a sign that the market is not really concerned about inflation. It's more concerned about growth. It is more concerned about the labor side of the situation here. And if we take a look at some of these ratios, and we'll just do this now, we'll jump into this because it's always a little bit more relevant actually to attach it to this side of the analysis. I mean, look at these trends in the different duration bonds, right? Long side, medium side, short side. They're all pointing in the same direction, telling you like, hey, forget about inflation for just a second. I know PPI came in hot, but you're going to have some major concerns with growth. You're going to have some major concerns about the labor side of the mandate here in a very short order. Like, look at how aggressive this is of a downtrend versus how sideways we had been through the end of not just 25, but early stage 26 as well. Let's now take a look at the Fed Watch tool. Hopefully all this stuff is still configured on the backside. It is. Are we logged in over here? We're not. Yeah, so I likely have to blast in some screenshots. Fed Watch tool. Here we are. Let's give that a refresh. And let's take a look at the probabilities table. And what do we see? 92.6% odds for a pause in the next meeting. And as we know, the labor situation starts to be unveiled to us this week as we move forward into this upcoming week's worth of data. We get manufacturing PMI and services PMI from ISM. Both of those are influential. They always are, more so than the S&P Global, flash and then final, in my view, because well, number one, I guess it is just the ISM, so it carries its weight because of the institute that it is. But then also, they do a great job of splitting out those three variable points, right, where you can sort of see what's going on with both demand in terms of new orders, prices paid, inflation, and then also employment. And the same thing here for services, right? New orders, prices, and employment, right? And we'll see if we get those three data points in alignment. What we're not getting, it's just a little odd, is the JOLTS number on Tuesday. That's going to be pushed out to the following week, even later than the labor report that we have here on Friday. So my belief is that you probably see an unemployment rate that's unchanged. The reason I say that is because if you take a look at this, you get a little spiking action happening over here, but nothing crazy on the initial jobless claims that would move the needle for the overall unemployment rate. I think what really the market cares about is what's the pace of hiring, right? And in the subsequent report, so not this one, but in the subsequent report, then we might see things like, okay, this AI takeover after, I think Jack Dorsey's note on X sort of was a big wake-up call to a lot of folks. Like, you could either do it slowly over time and destroy team morale, or you could just have this one really harsh moment. And I think if companies go with this first outcome, or I guess I said it second, but the second outcome of the one harsh moment, but from there you sort of like rebuild, that's going to show up as a big spike in the unemployment data, right? So I think that's what is really on the market's mind as something to continue to be sort of concerned about. Let's go on over here to the earnings calendar. Let's just clear this up for their more recent. Jumping over here and grabbing, there it is. This week's, what do we have? Well, CRDO is worth watching. I'd say Riot, perhaps. Big Bear AI. Those catch my attention. ASTS, of course. What else? Archer, perhaps, on the Monday session after the close. CrowdStrike grabs my attention. What else is an interesting name on Tuesday? Not much there. Maybe, just because retail's, like in the background, it's still been doing all right. Retail names there. That's pre-market. Let's see post-market. Broadcom, of course. Rigetti, of course. Bull would be interesting. That's primarily where I'd be on Wednesday. Absolutely for fiber optics here. Kroger, maybe. What else? VSCO has a decent bull flag on the daily chart. Marvel, bottom tier semiconductor. Costco, definitely interested in that. And I think that is mostly it for earnings this upcoming week. Those are the names that I would focus on as we look through the calendar here. And with that, we will just bounce straight back on over to the platform, finish up the supporting evidence. I mean, the only thing that you'd read in the FactSet sheet is the NVIDIA earnings, right? And we all know about NVIDIA earnings. NVIDIA earnings came out stellar, absolutely fantastic, but how was the market's response? That's all that really matters. Market's response was down. So let's jump on into supporting evidence with credit spreads. Weight of the evidence approach tells us that this is another data point for the bears. Credit spreads are expanding. That's indicative of volatility, which is not good for buyers and healthy markets. If you look at the HYG, it is out to a newer low over here, unlike the S&P, which is not out to a newer low. So just like we had a bullish divergence there, we actually now have a bearish divergence with the HYG. So noting that on this upcoming week, like early on, we have lower lows, right? And let me just draw it possibly to make the visual a little bit more clear. There's your lower low versus if we come in here, here's your higher low, right? Not even close to the same. So bearish divergence, HYG. Let's go with total breadth, unchanged, no change to this or this. That's moving averages and new highs versus lows. And we already talked about the RSP at the 205 breakout, no problem there. Let's go QQQE. Not much to really write home about inside the balance range. If we could clear the top, that would be a signal if it's early to the NASDAQ, but has not done so yet. Let's jump into volatility. You could see this trend line is something that I'm clearly watching. If you break the trend line, you just have a change in tone. We haven't done that in volatility, and I would imagine that with the over-the-weekend events, we probably get a VIX spike on Monday. The question just becomes, is it sustained? Do we start finding a floor above 2050, somewhere in here, or do we just immediately come back below and become more comfortable? That is the million-dollar question on the VIX for Monday that I will be trying to answer into the close. If we look at the VVIX, it is elevated over the warning trigger at 103. I again think that this would spike over 120 for Monday. Let's take a look at the vol futures. I don't know that these would dip a toe into backwardation here under the zero line, unless there is something new and notable intraday on Monday. Maybe related to the Fed, maybe less related to geopolitics. I don't know that you're going to invert vol futures here on the headline that a couple of strikes took place. So that's my 2 cents. If I just zoom back out over here, then a small inversion back over here, that would have been in the summer when they struck the nuclear sites. You guys were all over my pronunciation of that on Friday. Anyways, VIX one day, that'll be a big tell as well. Do we spend more time over the 1275 ceiling, which is the comfort ceiling, turn that into a new floor, and okay, let's keep our wits about us. And once again, as we've walked through the weight of the evidence here, I mean, breadth might look a little bit more bullish. Sector posture looks a little bit more defensive and bearish. Volatility doesn't look all that healthy, but nothing that's like overly alarmist. It's a mixed bag. Like, it's kind of like a 50-50 weight of the evidence approach as the market's balancing off here. And I know I might sound like a broken record, but please forgive me if the reminders just help one person from blowing up their account in this chop and slop, then I guess it's worth it. But maximum flexibility. Just wait. Let the market tell you. Let the market tell you when we're here and when we're here, and then we have something to do. If we're just this, then, it is what it is. Let's get into from the supporting evidence core list and start with NVIDIA. I mean, how can this not be telling us something? Best earnings to date, and the stock is down 2 big days in a row, washing out this entire balance range, gap and go to boot on the Friday session. Maybe a 200 SMA bounce. The only thing that I would sort of say is like this was a similar situation where you had really strong numbers and the stock plummeted. So you had 2 days down hard, and then you started to undercut that low and then bounce. I would start looking for something similar on NVIDIA. Are we going to start getting some kind of, an undercut of 200 that then comes back above and we can long to close the gap? Even if it's just a counter trend trade, even if it's just a support trade, like a simple support trade off of 171, that might not be the worst thing in the world, right? So another hard down early on Monday, catching lows and trying to look for a turn there. As long as it's tight risk, right? I wouldn't just try to catch the falling knife if it's a solid red-bodied bar. Absolutely not. But if there's some reason to believe intraday that previous support can act supportive again after a hard down wall-to-wall move, look above and fail A all the way to point B range low here, right? Then sure, a little counter trend off that level, not unreasonable. Look at the volume. I'm not going to call that capitulatory volume, but it's elevated for sure. Let's jump on over to Apple. Apple's a little tough here. Caught between a rock and a hard place. I think you could still get support here over 261, but no doubt about it. Weak on that Friday session, falling out of bed completely. Losing the moving average stack, losing this as a double bottom neckline. So I think here gets you to 161, and then just like, okay, what happens at 161? Nice linear moves out of Apple. I would say that probably worth a watch. What happens at 261? That's kind of my top priority early on in the week. Let's go on over to Microsoft. Just like IGV, this is going to be a top priority as well. I was liking into the Friday session the attempt to hold a majority of price action over 393.25. I would be curious if we could get above that, right? It's the same idea as the IGV. If we could go look below and fail, high or low above, inverted head and shoulders. Are we going to start breaking a trend line in here? Are we going to get over the 20 SMA? That's the next step really for Microsoft. Can we get some kind of action constructively back up towards the top of the range if we could stay over 393.25? If we can't, then forget about it. An equal low flush has this gap to close down below at 373, 367.50. Let's jump on over to the Amazon chart. What do we have here? Inverted head and shoulders on the daily. Excuse me. I still, there we are, really like this up and over 312 for something along these lines. I mean, they caught a lot of flack on, maybe not them directly, but the Anthropic investment, right? Anthropic and the U.S. government really pushing back on that hard into the close of Friday. Amazon's got some exposure to that, of course. So I still like 212. If you could just climb the wall of worry and everybody just writes it off as being like, okay, fine. They still have, good models and, Claude Code is changing the way that work is being done and the whole 9 yards, then fine. Amazon there over the 212 is not bad as an idea still. I don't really love trading it inside this range here. I'm personally just waiting for that one move into the earnings gap. Let's jump on over to Google. Google getting a little bit head and shoulders-y here on the rollover off of the moving average stack. I don't like where it's currently configured. You had a couple of days where you had hammer highs that you could have taken into the moving averages, and it just didn't go. So hard higher into the Friday close. I mean, maybe it's worth giving a little bit of respect here, and can you get to the 20? The thing I don't like about it now is, like, if you took out the hammer high from Tuesday on Wednesday, at least you had some range into the moving averages. Now, I mean, you have to imagine, right, this is going to stair step down again and look like that. Your target's becoming smaller and smaller and smaller on the top side for Google at the 20, acting as that key resistance. So don't love it on the Googler here, but continue to just kind of keep an open mind. Going over to Broadcom, they have earnings this week, so probably no options trading over here for me until we're through the event. And I continue to just sort of think to myself, like, intraday bears don't really have it. Another harsh snapback right to the daily 200. So I'm curious if this is trying to act as a, the classic saying is the beach ball underwater. Is this a beach ball underwater that's just kind of waiting for its moment to do this? Maybe. I mean, it's undoubtedly lower since, the last earnings cycle. Let's just be honest about the chart here. It's undoubtedly lower, but I mean, really, how much lower has it gone from this low? Not really that much lower, right? You got a little bit here, a little washout to the 200, but immediate snapback. The gap down was bought back up. This lower wick was bought back up. This got bought back up. It seems to me that this, based on price, sellers are not overly aggressive in Broadcom. Does not seem to me. So we'll see what earnings has for us, and then, of course, we'll reset the chart. Let's go on over to the metaverse. I wish I had something constructive for you over here. Double bottom failed on that Thursday session, and Friday you're just inside the chop and slop. So I don't like the moving average spaghetti. I don't really like the daily range from back over here. Remember, we had this really nice flush back over there, and that was awesome, but you're right back above that level doing the same thing with these chop and slop blocks. I really need to see it here, over 678.50. So moving along. Tesla, another one that's just like, it's doing its own thing. It's in its own little world. Break the trend line. Maybe there's something new to do on it, but for now it just remains short as a pinch between the 20 and the 200, and that's really it. I just don't love Tesla's chart in here. Just like I don't love Meta's chart, that's fine. Like there's not always something to do on every chart. Got to be okay with that. Looking over at JP Morgan, hammering off the daily 200. Financials look weak overall. It's still in a downtrend here. I'd be looking for consolidation lower. If we spend more time under the 200, this becomes a real threat for the XLF, which of course will just put the pressure on for the XLF and then subsequently market, right? Let's jump on over to Palantir. I do think that this is tradable early on in the week. So balancing out from this range and trying to move higher through the 20. If we take a look at the intraday chart, right, if we can get some kind of break up and over 137 here into this high, that would be a look at 140.75. I'd be interested in watching that potentially on PLTR. Let's jump on into AMD. AMD's got for us not a lot. As I looked at the daily chart here, doji in the middle of nowhere. If it tightens up down here, maybe turns into a bounce off of range low. Maybe. I don't like range low. Perhaps maybe a bounce off of it, but pretty loose. Pretty loose. I think 204 rejections keep the pressure on. 204 reclaims would open it back up to the top side. So really just treating it as a balance range. You're approaching the bottom side where risk reward starts to favor, moves in the upward direction, right? There is a big unfilled gap underneath us here, but there's the weekly pivot and the daily 200. If it tests that, that would also be a long, in my opinion here, if we were to get something that looks like that. Let's jump on over to Robinhood, and then we've got 4 additional ideas to end on. It's starting to get a little sunny out here, and hopefully you guys have a decent weekend brewing as well. I know we had monthly charts to talk about today, but in a balanced market, I hope we tried to make it a little quicker today. Robinhood, midpoint of the range. Crypto looks a little weak over the weekend, or I should say even just over the end of Friday's session. 65,150 is being reclaimed into this morning. Or I'll just bring this over because why talk about something and not show it at the same time? So here we go. Here's Bitcoin. All right, see how we had this low in here that I preferably wanted to see held. If we just zoom back into this on the daily. So we had this low that I wanted to see held. in here, and we clearly overshot it on the strikes and such. So now that we're back above it, maybe it's another look below and fail. I would be open-minded to, on an hourly chart, can Bitcoin attempt to find a Brigade bolt above this? And if so, maybe that helps the narrative for, and the whole reason we're talking about Bitcoin right now is because we want to be talking about Robinhood. Robinhood will likely follow in the heels of Bitcoin. If Bitcoin can be strong over the weekend, in the wake of all this strike news, then maybe we have this. And that's still the primary trade. Just to bring it full circle back to Robinhood, the primary trade I'm looking for is the earnings gap close, over 80 to 85. If we're just doing this, I'm not really interested in trading it in the chop and slop. All right, I've got 4 ideas for you. The first one's on keys. Keys. Who's got the keys to the BIMA? Sima. Well, you got the keys right here. Look at this inside bar. This reminds me exactly of FSLY, right? FSLY. Get the correct sequence there. So earnings gap up sideways, right? It may give some wicks and some frustrations up there, but look at how just on the earnings gap up, huge volume coming into the sustained volume as we're consolidating up in the highs. Looks more like accumulation here to me. So keys over this 308, 300. Who let that slide? Yikes. Who let that slide? Let's just go 25 is fine. Over Friday's inside bar high, hammer high, I think you're starting to get going in the upward direction there. I don't know if this is all-time highs. Yes. Keys all-time highs out of this, right? Base from back here. This is the first sort of major consolidation. This was an okay rally here, but first major consolidation after the earnings gap and go. I like it. I like keys quite a bit out of this little range, and we'll see where we can go from here. So that's the first idea, monitoring that, adding that to the universe list. Let's go Caterpillar. Caterpillar, in my view, is interesting off the 20 SMA hold, and XLI looks good, right? So if XLI is going to bounce, just a reclaim of the bottom end of the range, you have look below and fail. What do you target? The top end. Top end of the range here would be about 777. I'm just going to make it funny and go 77, right? So all the sevens there is going to be the target. Right, top end of the balance, just like that, over 750, looking for that high of the little range. That could be a day trade. It could start as a small day trade that develops into a swing if you believe it goes out to new highs. That's if we could take out Friday's high on Monday. Let's go from CAT over to KRMN. KRMN. Take a look at this as a double bottom. If we can retake this, you're also taking out the double bottom neckline, but 20 SMA as well as the 50 is right there as well. And hopefully the break would bring both of those in at the same time. Break, Brigade bolt above, thin structure retrace back up towards the highs. That would be a substantial move on a percentage basis. This thing is a mover. If you're to get back up here, that is what, 27% back up to the origin of the breakdown. I'm not saying we have to go there. I would certainly argue for this acting as a key level as well. Opening print of that bar, let's call that 98.50. So let's be realistic with ourselves. Let's take it one day at a time. But I like this as a higher low. I like this inside bar on Friday. I like the potential for a moving average reclaim up and over 88.50 to 98.50 and then monitoring for continuation. Good volume on that Friday session as well. It's almost like somebody knew something, right? KRMN. These guys, by the way, are in military and defense contracting. Anyways, let's go on over to the final trade idea, CRCL. What's going on with the circle? First pullback after this big break on earnings. We know stablecoins are becoming more and more of playing more and more of a role in payment processing. You've heard Fed speakers talk about this recently. You heard the metaverse talk about this recently. Look at the hammer, small undercut of the prior day low and then closing inside range. Light volume. If we could take out that high, can we just go back up to the high is the question. If we're underneath Friday's low, a little less interested, but is this the first pullback here and over its high gets interesting towards the equal high? That would be this target there at 89.75. So that is CRCL into early stages this week over the Friday hammer high. That's what I've got for you in today's episode and installation of the weekly watch list. Hopefully you enjoyed the video or learned something new. Again, let the balance range tell you when the opportunity set is going to open up. If you haven't figured it out, the market regulates the number of opportunities that you get. You do not regulate the number of opportunities that you get. You have to be prepared to take the opportunities when the market starts presenting them. And as of right now, we're still in the balance range. We've been frustrated here, back and forth, lack of follow through, this, that, the other. It's not going to last forever. We have a couple of catalysts this week. The expected move is suggesting over or under the balance range, and we'll see if we can get the job done. So have yourself an awesome weekend. Stay green out there this week. And as always, I will see you in the next one.